Hi, welcome to Go-to-Market Navigator by Fin Capital, our ongoing series where we break down the essential components of nailing the right go-to-market strategy. I'm Lauren Houpt, Operating Value Associate here at Fin. Today we're diving into all things metering, billing, and pricing with co-founder and CEO of Sequence, Riya Grover. Sequence is a modern billing and contracts platform to help finance teams unlock error-free revenue. Really looking forward to the conversation. Thanks for joining us.
Thanks so much for having me on, Lauren. I'm Riya Grover. I'm the founder of Sequence. We're a Fin Capital company. Previous to this, I was an entrepreneur. I built and sold a business in the food tech space. So this is my second run. And yeah, Sequence has been going for a couple of years. We're a revenue automation platform for B2B finance teams. We help finance teams translate the terms of any custom sales contract into a structured data set so that they can automate all of their downstream revenue operations like billing, invoicing, revenue recognition, and kind of synchronization of data with other systems of record like the ERP and the CRM. Really, why we're kind of tackling this problem is that we see a lot of businesses today leverage kind of more complex pricing models, particularly fintechs leveraging usage-based pricing and hybrid pricing. And also a lot of B2B teams use custom deal terms and giving them a set of revenue tools that enables them to kind of sell with custom deal terms, but then achieve automated billing and invoicing off the back of that is what we're going after.
That sounds great. And I would love to hear kind of, what is the current state of billing in B2B fintech? Would love your perspective. What pricing models do you typically see teams using right now?
Yeah, so I mean, the fintech industry has definitely been an kind of early adopter of usage-based pricing, fraud detection companies charging per API call, payment companies applying tiered volume-based fees. I think these pricing structures are very familiar to customers, within these fintech markets, be it platform fees, usage, or in some cases seat-based models. They say don't reinvent pricing. Use and adopt pricing models that are intuitive and minimize friction for buyers. And so, obviously, to stay aligned with market expectations, we of course see a lot of these fintechs deploying usage-based or usage-based as part of a hybrid pricing strategy. Kind of worth noting as well that I think this model typically creates pretty strong alignment between the fintech and their customer success. As a customer processes more payments or makes more trades or grows their loan volume, the fintech grows proportionally, and this really incentivizes them to help their customers succeed. Also, interestingly, I think helps fintechs to serve both small and large customers effectively. So small businesses can start with low costs while their volumes are low. Larger enterprises obviously pay more as they use more services. And this kind of reduces barriers to entry, but it also means fintechs can protect their margins when often, the kind of infrastructure layer that they're paying for underneath is also charged per usage. So, if a fintech is paying 10 cents to process a payment, they can charge 15 cents and maintain their margins regardless of volume. And so, yeah, I think obviously usage-based pricing kind of very prevalent amongst fintechs. I mentioned kind of use of this within a hybrid strategy. So we'll often see this in combination with subscription pricing. And then what we also see with a lot of fintechs, which is really kind of the market we're playing in, is that fintechs will often deploy a sort of sales-led go-to-market motion and leverage custom pricing and deal terms for their end customers. And so, things like, potentially varying those tiers, pricing tiers, depending on the customer segment they're selling to, or implementing trials or minimums or kind of certain discounts alongside their pricing. And so that's also extremely commonly deployed in B2B fintech.
Awesome. I appreciate that. That makes total sense. And I would love to understand, how is Sequence solving for this? What products are either in the pipeline or that you've recently released that are helping with these pain points?
As I mentioned, Sequence has built this kind of modern set of revenue tools for B2B teams who have, custom or complex pricing models. What we do is we capture new contract, upsell, or renewal data. I'll talk a little bit more about how we do this, and kind of seamlessly feed that to the finance team with kind of perfect accuracy, so that finance teams are then able to automate billing against those contracts, invoicing, and kind of revenue recognition, as well as some of the other receivables operations like payment reminder workflows. I guess the sort of you'll see kind of a bunch of products out there which are really designed for like very standard plans or very standardized pricing. Stripe is obviously kind of in that world, but what we're leaning into is when companies do have these custom deal terms, ultimately the data for that lives in a sales contract, which can sometimes live as a sort of offline PDF artifact stored somewhere in a Google Drive or attached somewhere in Salesforce. And ultimately, for finance teams to be able to bill and invoice with accuracy, they need to be able to perfectly kind of in real time capture that data. And so we've built kind of that sales to finance workflow, intake workflow, as a kind of core part of our overall suite of tools. Just because it's so important for kind of accuracy of all the kind of downstream revenue operations, that upstream data holds the source of truth for kind of every downstream operation that's going to happen. The way we've done that is, so we have a CPQ product that companies can adopt. Sales teams can use our quote builder product to create pricing proposals, order forms, and then we kind of perfectly can extract that data into the finance engine. And actually, upcoming this quarter, we're launching AI-based contract ingestion, where companies can just kind of forward their sales contracts or drag and drop them into sequence, and we can use AI to entirely kind of extract all the commercial pricing terms, contract terms from that contract, so that finance teams can automate their operations off the back of it. A couple other kind of pieces that we've leaned into very strongly. I think we've really invested a lot in designing a product which companies can onboard to quickly. I think billing and pricing can sometimes feel like a big lift for companies. I think a lot of the legacy tools in the space, it'll take you sort of 6 to 9 months to onboard and implement something that actually reflects your pricing structure, whereas we've just been very intentional about making it something that you can set up in a few weeks. And this can be done through the dashboard for non-technical operators. Ultimately, finance and RevOps users are the users of this product once it's implemented, but it can also be done by API. And I think this combination of supporting more hybrid or complex pricing structures alongside these custom deal terms that you might have in a contract, I think is something that we do really uniquely, and is sort of the market that we're leaning into.
Awesome. That makes total sense. Yeah, I have definitely been on teams where there's no finance workload that exists. And like you mentioned, contracts are just all over the place in Google Drive or SharePoint. So love that you're solving for that huge pain point and saving teams a bunch of time. Awesome. Well, I would also love to hear, when should companies start to build out their billing systems in-house versus outsourced to a provider like Sequence? A lot of our portfolio companies that are probably joining in on the call, we have folks from early stage all the way to pre-IPO. So when should they start thinking about that? And how do you even choose the right vendor?
I mean, our point of view is that you should never build in-house. I guess, companies should be focused maniacally on solving the problems for their customers, building product for their customers, and every bit of engineering resource that is not focused on that is ultimately kind of means that they're you're not driving as much customer impact as you can. But I do believe that it's important to have something really scalable and kind of automated in place really as early as your first 30, 40 contracts in the business, even less in some cases. You start to run the risk of missing things, especially when you have some slightly more complex pricing structures. It's very easy to miss like a tier or a minimum in a contract. That means that you basically miss revenue, leave revenue on the table. But also, like, by having a more streamlined workflow, so from quote to cash, let's say, and kind of having that right kind of revenue system in place, it also means that, like, from the early days, you're capturing much better data. You kind of have a unified source of truth between all teams on your usage, your revenue data. That can be that means kind of whatever's in your ERP is like well aligned with what's in your CRM. And obviously, this gives you kind of a ton of agility as you kind of thinking about your go-to-market and equipping your sales and RevOps teams with the data that they need. And so I think having a system in place early to streamline that revenue workflow is really important. But I kind of strongly believe that it doesn't make sense for companies to build in-house. It's a huge product surface area. I think companies set out building with their existing pricing model in mind. The truth is like they're probably going to change pricing, add new products, start leveraging kind of certain custom deal terms. And it's all the edge cases in billing that like really add up to making it quite a complex product surface area, right? Like, if your sales team use a pricing ramp, like thinking about how that plays out in your billing, like if someone adds a seat or upgrades mid-month, thinking about proration of that in your billing logic. And obviously this becomes all the more complex if your pricing varies across your customer base. So it is a huge lift. I think, we've seen, especially kind of before products like this existed, like a lot of large tech companies did build billing infrastructure in-house, and it's there's tons of war stories on why, like, it took them, expected to take weeks, it took actually years in the end, and it's never done, and it just kind of absorbs a huge amount of resource. In terms of what companies should think about when thinking about choosing the right vendor, I think, does the vendor support your pricing models and give you flexibility to adapt pricing as you scale? Does it support your go-to-market motion? Are you primarily a PLG company, or are you sales led? Are you hybrid? Between the two, if you are hybrid or sales led, something like Stripe probably isn't going to work for you as well. If you're entirely PLG, it probably would work pretty well. And then, also I think looking at onboarding and setup, and also, I guess, who, like, the user experience for the people who are operating it. So, how quick is it to onboard and get going? Given your finance team and your RevOps team are probably going to be the primary users, can they make changes in the dashboard without needing to lean into engineering support? And then another kind of key piece I think that's extremely important for like the modern tech company is, how easy is it to get data out and orchestrate this to other places where you might consume this data? We talked about other critical systems of record, like the CRM and the ERP, companies' own data warehouse. Because if you think about it, like revenue data is so critical for, informing, sales decisions, for informing sales commissioning, even kind of informing, feature flags on product access. Sort of contract data is essential for that. And so thinking about how easy it is to get data out of a system and orchestrate that to the other places you need it, I think is also really important. One of the things we actually do is we have an RFP sheet that we've created. Like sometimes when companies come to us and we, want some help in thinking about all the different things that they should consider, we actually share a kind of standard RFP with them, giving them kind of all the things that they should be thinking about when choosing a billing vendor. Because I think there's a number of considerations, and once you put something in place, you want it to be able to scale with you for a long time.
I 1,000% agree there. And I love that you cut out the data piece, which I think is especially important for RevOps teams, especially as they're putting together their KPIs and everything. But would love to kind of shift the conversation to get your thoughts on pricing. Specifically curious, what are some of the challenges you're seeing companies face when implementing custom pricing? What does custom pricing even mean? How is it being defined? Would love your thoughts there.
Custom pricing really just means that each customer might be on slightly different pricing. Pricing is custom at an individual contract level. That doesn't necessarily mean you're deploying a different pricing model for every customer. Often your pricing model is consistent, but larger customer, you're taking up the price of certain tiers, or you're embedding kind of certain incentives for multi-year terms. Like this is extremely common, and it's what it takes ultimately to get deals over the line. No two customers the same. I think the custom pricing doesn't have to be challenging. It's a very like natural part of a sales-led go-to-market motion. It only becomes challenging when your billing infrastructure constrains your ability to leverage custom pricing, where, for example, if a sales team deploy a minimum or they deploy a free trial, if your billing engine isn't able to handle that, I think that's where it really creates friction downstream. And it means that either, your operation's extremely manual, or like in some cases, you just actually can't bill or charge for that. Obviously, companies who are deploying usage-based pricing need the infrastructure to be able to kind of like define the value metric that they're charging on, measure it, but also then connect that usage event data to whatever terms were agreed in a custom contract. So when every customer is on slightly different pricing, making sure that you're billing for the usage against the pricing terms agreed for them is really critical. And I guess that's the sort of pieces that we're putting together, that whatever was sold in a contract connected to whatever usage was actually consumed, and kind of connecting those two things. And so the right infrastructure, the right tooling is needed, but it doesn't necessarily mean that the use of custom contracts, the use of custom pricing has to drive complexity. I guess one other piece to think about is, again, like the contract determines so much of all the revenue operations downstream. With custom contracts also comes the need to kind of adapt revenue recognition. So for companies who are using usage-based pricing and custom contracts, finance teams need to think about things like usage-based revenue accrual and tracking and recognized outcome-based revenue, complying with the right accounting standards for the complex or the custom pricing that they're deploying. And then I think another really interesting piece as well is, I guess, in a world where you're just using sort of subscriptions, like the implications on the CS team, the sales team are relatively the sort of management of that is relatively simple. You have an end date, and then there's a notification in your CRM as to kind of when that end date is, and you reach out for a renewal. In the world where companies are deploying usage-based pricing, the signals required for customer success and account renewal also change. CS teams now need access to usage monitoring. They want to be understanding how value is being realized across that contract. They're going to get signals for upsells and renewals. And I think it's really important to think about this connection here between sales and finance is really important both ways. It's important both for finance teams to be able to have accurate data and capture that seamlessly with whatever sales are doing, but it's also really critical for sales, CS, and RevOps to have access to billing, usage, revenue data back in the places that they're working, so that they get the right signals to kind of grow revenue further.
Yeah, totally. Awesome. No, I really appreciate that insight. And I think it'll be really helpful for earlier stage companies that are tuning in to this session as well. And as we know, most companies now are implementing AI offerings. And so I would love your thoughts on how AI first companies should be thinking about value metrics and how to charge for those.
Yeah, I mean, we're seeing a ton of pricing evolution by virtue of, the insane growth that we're seeing with AI companies. And I think there's some really interesting trends that are just starting to, I guess, kind of are just starting to unfold that I think we're going to see a lot more innovation around. But one thing that we're starting to see more of is outcome-based pricing. So you charge customers only when your product is successfully achieving a business outcome. Imagine buying a marketing tool and paying only when it generates qualified leads, or a customer service platform that charges per resolve ticket rather than per agent seat. This is definitely kind of gaining traction across the software industry, but particularly with kind of AI-powered software and agents, where typically, tying the payment to an actual outcome is a really effective way to sell the product. Obviously, this is great because it massively aligns incentives with customers and appeals to decision makers who don't want to make big upfront investments for software. But I think one thing to note on this is it's not always easy to define the specific outcome your product provides. And I guess also proving the product is directly contributed to the outcome for the customer can sometimes be challenging. And so, I think the other thing also is, once you're kind of actually charging based on outcomes, the people almost start to question those outcomes and the efficacy of them as they unfold. So I think it comes with its challenges, but certainly it's a model that's gaining traction. We're also seeing output-based pricing emerge quite a bit. So this is the case where you can charge customers on completed tasks or outputs rather than input metrics like API calls or compute time. So it is a kind of a usage-based pricing model, but whereby you're kind of looking at the output as opposed to the input metric. Like an example of this is Jasper AI charges based on the number of words actually generated, or some fraud detection tools charging per flag transaction. Again, I think in the previous case, this works if the outputs can actually be measured transparently and align closely with the value the customer is trying to derive from the platform. I think one of the quite neat things about this is that it really positions the AI as a direct replacement for human FTEs. Like by virtue of choosing that kind of pricing model, which is kind of directly linked to like the tasks being completed or the outputs being generated, you're essentially, I guess, sort of mentally positioning this offering as sort of an alternative to human labor, and that gives the ability to charge 20 to 35% of the kind of fully loaded cost of a human, as opposed to what you may be able to command from a software perspective. The other interesting thing about this is it also allows you to kind of tap into hiring budgets as opposed to software budgets. So people typically spend a lot more on hiring people than they do on software, and like you can tap into those budgets. And also kind of use signals like open job posting as a powerful prospecting signal. I think it's a really interesting approach. And like this is a great example of where the pricing model is directly like framing the perceived value in the minds of the user. And I guess like one other kind of interesting piece on the sort of, I guess, new pricing models we're seeing is this skills-based differentiation. So OpenAI introduced ChatGPT Pro at $200 a month, is 10x the price of GPT Plus. And what this is really saying is we're shifting from feature-based to skill-based value propositions. In this case, the AI capability levels, the reasoning, the problem solving, the enhanced memory is so much more adept than the base version that you are paying for more skilled labor essentially. And I think what's quite interesting is historically we've always seen people charging more, SaaS companies, fintechs charging more for like the good, better, best notion for more features. The better plan has just more features included. Whereas actually, if you're kind of hiring an AI to do the job, you almost want to ungate access to whatever features are needed to get the job done. And so in some ways, like you're paying more for higher skills, but actually it's not at all grounded in how many features you're getting access to, and you're ungating as much as possible for the AI to work. So just some like very, very early examples of some pricing evolution that we're seeing. But on the point of hybrid pricing, I do think we're going to start to see even more kind of hybrid pricing implemented, where companies are deploying some of these new pricing models on potentially like a new AI feature that they launch whilst retaining kind of some of that existing pricing that they've been using.
I guess a follow-on question to that would be around, how should companies prepare for pricing changes, whether they're AI focused or not?
Yeah, I mean, I think one thing it's important to remember is pricing is never done. And it's really critical that like teams have the ability to adapt pricing approaches as their product evolves and their go-to-market evolves as well. The billing and invoicing engine, the finance engine should never constrain the go-to-market team in sort of seeing new trends and capitalizing on them or leveraging the deal levers that they need. I think it's important to remember when pricing does change, this does have implication really across the business. We've talked a little bit about sales, CS teams, RevOps teams. Obviously, finance need the right infrastructure to be able to actually kind of bill and invoice against whatever pricing model has been chosen. But if you are adopting some of these new pricing models, whether usage-based or outcome-based pricing, being able to track and measure that, being able to connect it to the contract terms, and then actually being able to orchestrate that data that's being generated, that usage and revenue data, and kind of how customers are using you to actually then be able to make smart decisions off the back of it. I think pricing does have kind of widespread implications, but it doesn't mean it needs to be hard. And what you want is the agility to kind of do what you need to do to win.
Well, thank you so much for joining this edition of Go-to-Market Navigator, Riya. Really appreciate all your insights. And for those that are tuning in, just make sure you check out Sequence to help solve all those billing and metering pain points. If you had any closing remarks, feel free to share. But I think we're all set on the Fin side.
Great. No, it was great to be on. I mean, only closing remark is that we're leaning, very strongly into leveraging AI in thinking about how we can help teams, automate more of this multi-step workflow, kind of capture smarter, intelligent insights on their revenue. And yeah, lots to come from Sequence in this space. So yeah, excited to share more over the coming months.